This week, the Federal Reserve raised a key interest rate, half a percentage point, marking the highest rate increase since 2000. The Fed instituted the rate hike as a way to counter the worst inflation in 40 years. But what do these numbers mean for everyday Americans? For that, we're joined now by Kayla Bruun. She's an economic analyst for Morning Consult. Thanks for being here to break this down for us. So explain why the Fed has raised the interest rate. What is the goal? It's to slow down spending and bring inflation down?
Hi, yeah. So first of all, thank you for having me on. If there's one thing that the Fed made very clear with their press conference after their meeting this week, it's that taming inflation is really their number one priority right now. And the reason they're so focused on that is that the last few prints we've had of inflation have continued to get higher and higher. Most recently, we saw the rate at 8.5%, when typically what we'd imagine is more of a healthy level, sort of a rule of thumb is closer to 2% or around that on average. And the main mechanism that the Fed has to fight inflation is really to raise interest rates, which they've begun to do and have stated their intention to continue doing going forward. And what that really does is it makes borrowing more expensive. So when it's harder to borrow, it's harder to spend. That in turn cools down demand and takes off some pressure from prices and cools overall inflation. So that's what they're hoping kind of takes place over the next few months.
And so everything we purchase on a credit card will go up. Explain.
Yeah, so when the Federal Reserve raises the federal funds rate, that's sort of like the baseline cost of borrowing, and other lenders will typically follow suit. So that would include credit card companies. And that's something that really is going to add some strain to a lot of household budgets. We see in some survey data at our company that between 25 to 30% of adults in the last few months have been saying that they do typically carry a credit card balance. They'll be paying interest on that, and they'll be paying a higher rate than they have been prior to the interest rates. So on top of inflation, with prices already getting more expensive, now borrowing is getting more expensive too.
And so many people have been buying so much on their credit cards coming out of the pandemic and then even throughout the pandemic. Okay, let's talk about the housing market. How will this affect mortgage rates, the housing market in general, rentals?
All of these are good questions. We're actually seeing impacts on the housing market already. Specifically, mortgage rates have already gone up because the Fed was very vocal about sort of broadcasting what their goals were and their intentions were for raising interest rates. So mortgage rates kind of jumped up ahead of the recent rate increase already. And that's already showed signs of weighing down demand for housing. A couple examples from our data. We ask every month how many adults in our survey are planning to buy a home over the next 12 months, and the share has declined from the same month a year ago. And then at the same time, we also ask whether consumers think that buying a home is a good investment, and the share who say it's a bad investment has been kind of steadily climbing over the last few months. So those are some early signs that the increasing interest rates are already having some progress with furthering the Fed's goal of kind of cooling housing demand, which is a really big component of inflation.
So if you want to sell your house, you better do it soon, it sounds like. Let's talk about gas. We've already been feeling the pain at the pump. What should we expect when it comes to gas prices?
Gas prices are a little tricky for the Fed because the things that are driving the price increases, which are a really huge component of what's been driving up inflation overall, the gas and food costs too. But what's been driving those price increases are more on the supply side. And the tools that the Fed has to calm down inflation are really more focused at demand. So that puts gas and food price growth a little bit outside their control. Honestly, we're kind of just hoping, kind of crossing our fingers and hoping that some of the factors, such as like the war in Ukraine and supply chain disruptions, hopefully that the pricing pressures from those factors will start to abate. And that's really what will help bring down the food and energy costs, not so much something the Fed can have a hand in.
There are so many factors at play here, and some of them are competing factors. Kayla, thank you. Appreciate your time tonight.
Thanks for watching. Click the red subscribe button below so you can get more of NewsNation's fact-driven, unbiased coverage.